All right, so warm greetings to you, colleagues. Welcome to our lecture 14, video A in text 3761 in this 2024 academic year. So our central focus in this engagement, it's pertaining to this past examination paper that was written in October, November 2021 academic period. So in the previous lecture that I anchored with you guys, I began to do a discussion of this paper, in particular pertaining to question number 1 of this past paper. So just to show the progress as to where we were in the guide of how to answer the question. So as you can see sharing on your screen currently, it's a Word document displaying the guide of how you are expected to be responding to the question in the context of the exam, right? So already from this document, you notice that I already began to highlight to you the approach of how they would want you to present the answer. So I think to make sense of what I'm showing in the Word document, I would have to first of all take you back to the question paper to highlight what was required, and then of course go back to the information. So if you go to the question paper that I've shared with you guys in the group, in the required section, they were requesting you in number 1 to calculate the normal tax liability of Garden Snake Pty Limited for the 2021 year of assessment. And then the instruction was stating here there to not start your answer with the net income. So if you go to the info, you were given a draft of the statement of comprehensive income of the taxpayer here for the 2021 financial year. And you notice the net income was given right at the bottom. So the instruction was saying, do not begin with this amount. Meaning to say, therefore, you have to begin with anything else but other than net income. And anything else that I'm referring to, it has to be, of course, what would constitute gross income in the eyes of the taxpayer. And amongst others, when I look at it, it was actually sales, other incomes, and the bad debts recovered, which constituted of course, of items that would fall within the gross income of the taxpayer. Remember, for something to be included in the gross income, it's either it has to meet or satisfy the definition of gross income, or it can be included as a specific or special inclusion, right? So it's very, very important to remember that. So to take you to that Word document, this is where we were. So it already addressed some of the aspects such as sales, other incomes, which still also get included in the gross income of the taxpayer, as in this context, because they did not specify what was in the other income, so would consider that it's part of gross income. And then, of course, bad debts are recovered to the value of 25,600 as well was included. There was an aspect about the trading stock, that trading stock deduction that we needed to account for. And where that information was emanating from, it was actually, from note number 1, where they're telling you what the breakdown of what constituted or what resulted in the cost of sales here, cost of sales here of 886,200. So you could not just take this amount as it is and then you paste it, as it is in the calculation, of course, of your income tax liability for this taxpayer. So you needed to reflect it correctly. So how would you do that? Because they gave you the breakdown of what made up or what resulted to that value, you need to then identify what is it that constituted of the trading stock deduction. So here we are told that the organization or the taxpayer purchased amount to the value of 895,600. And then, of course, these values that you're seeing here, the 146 for Feb 2021 and March 2021, it's because of the required part number 2 of this particular question, because there's something about VAT which you were expected to perform. And then, of course, the cost of the opening as well as the closing stock was amounting to the value of 156 as well as 165,400 respectively. Market value of the trading stock has never been below its cost. So now here is what you needed to do, of course, to account for that. So that's what we'd already done. So for the opening inventory, remember we're dealing with the trading stock deduction here. The opening inventory would have to be subtracted in the calculation for the income tax liability of the taxpayer, and then same thing applied to the purchases, and then but the closing inventory had to be added back, you know, to in that calculation. So we'd already dealt with that aspect. Then there was an aspect about the delivery vehicle, and I wanted to just, you know, show you how to account for that. Now, where do we get the information concerning the delivery vehicle? Let me see in this case, because already note number 2, we did tapped into that. Then let me see. Oh yeah, the delivery vehicle, it's right over there. But it's something that you could have done right at the bottom, but it's just something that I felt it was, you know, wise for us to consider looking into it. And it's because of it was really because of this note number 4.2. But even before we could have gotten to that aspect, we could have addressed everything else, such as salaries, doubtful debts, you know, rental of office space, interest paid to trade creditors, and other expenses. We could have maybe dealt with those first, but in any case, in this case, it really didn't matter much, because still all of these things would form part of the deductions and capital allowances of the taxpayer. So getting to information 4.2, because that's the part where we were in the previous lecture, to account for the delivery vehicle. So if you notice in the table here, they said you received the following information in respect of the assets held by the company or assets were brought into use on the same date of its acquisition. Right. Now, there was a delivery vehicle, according to note 4.2. The cost price or purchase price of this vehicle was 276,000, including VAT. When was this particular vehicle acquired? It was acquired on the 1st of April in 2020. And then if you go to information 4.2, something happened. A fire destroyed the delivery vehicle of the company, and this event transpired on the 1st of January 2021. The insurance company in this case paid an amount of 100,000 excluding VAT to GS on the 1st of Feb 2021. Binding general ruling number 7 allows for the write-off period on vehicles to be 4 years. So now, when you look at this information, colleagues, one of the most important things that you could identify from it is that it's an event that attracts what we call capital gains consequences, which is something that I would address in learning unit number 8. Of course, I may have not taught you about it as yet, but clearly it attracts capital gains. Why? Because of the fact that the delivery vehicle was disposed. But disposed in what manner? It got destroyed by fire in this case. So when you see something like that, where a capital asset, it's either sold or it's either destroyed, whether by virtue of an accident occurrence or by virtue of a natural disaster occurrence, in this case, the fire breakout, it will attract capital gains consequences. But however, what is important is to consider the event. When did it take place? Does it fall within the, you know, the tax period or the year of assessment that we are currently dealing with? So in this case, garden snakes, so year of assessment, of course, it's the 2021 year of assessment. Question is, when did that period started and when does it end? When does it begin and when does it end? So clearly, it ended on the 31st of March, 2021. Okay, where do we get that information? If you go to this part of the question paper, they tell you, company's financial year ends on the last day of March. On the last day of March, which is the 31st of March. So if we're looking at the 2021 year of assessment, it follows that the year of assessment here, it's actually looking as follows. It began on the 1st of April in 2020, and it's ending on the 31st of March in 2021. If I look at the event, that, of course, here in this case is attracting CGT, capital gains consequences, it transpired on the 1st of January. That's when the event of, the event of the capital gains in this case. It's actually on the 1st of January, 2021. Question is, when you look at the tax year period or the year of assessment of this taxpayer, it's definitely okay. It actually occurred within the year of assessment in question. So it means whatever that happened concerning this vehicle, it has to be accounted within that period. So question is, how do we account for this? Now I'm going to show you in the Word document how you are supposed to account for this disposed delivery vehicle. So here I'm going to say disposed delivery vehicle in the Word document. So now to account for this, one of the things you need to do when you're accounting for CGT, you need the purchase price of the vehicle, all right? And from there, purchase price of the vehicle, you will need to subtract what we call base cost, all right? You need to subtract what we call base cost, okay? But to get to the base cost, you need to determine the capital allowances, all right, over that vehicle, okay? So now if I look at, okay, I'm going to show you that part, of course. But one important part that we first needed to account for is the purchase price of the delivery vehicle, excluding VAT. And that is why you see the 276,000 being multiplied by 100 over 115. So I'm just looking for my calculator. If you do the math, 276,000 multiplied by 100 divided by 115, it will give you 240,000. So you put the 240,000 right over there. Then for the capital allowances, what is critical, what is crucial is to identify the period of or how long you've actually been having this delivery vehicle. So if I look here, it was bought on the 1st of April in 2020. That's when this vehicle was purchased. Why? Because we see this is the purchase dates of these assets. So if I look at the delivery vehicle, it was bought right at the beginning of our current year of assessment. So in other words, it was acquired in the 2021 year of assessment. Now, because we are dealing with a small business as a taxpayer, how do we know? The information is clearly given to you right at the top there, all right? They did mention in the second paragraph, the company's manufacturing process has been approved by SARS as a qualifying process of manufacture. The company is a small business corporation as defined in the Income Tax Act, Act 58 of 1962. So because it's a small business organization, what we need to do when we are dealing with or when you are accounting for capital allowances, especially on non-manufacturing assets, because this delivery vehicle, it's a non-manufacturing asset. So we need to then assess the value of that asset. Is it below 7,000 rands or is it more than 7,000 rands? So supposing if it was below 7,000 rands, let's say maybe it was 5,000 rands. What we were gonna do, we were just gonna be allowed by SARS to claim the entire 5,000 rand. But in this case, the delivery vehicle is worth more than 7,000 rands. So it means Section 12E capital allowances would apply. And that's where we look at the period when it was acquired. Is it within year 1 or year 2 or perhaps year 3 in that case? Remember, Section 12E says in year 1, you are allowed to claim 50% of the purchase price. Year 2, it will be 30, and then in year 3, it will be 20. In this case, we are looking at year 1. So what we would do to account for the capital allowances over this asset would need the purchase price of 240,000, excluding VAT, obviously, and then that value has to be multiplied by 50%. And why we are multiplying by 50%, it's simply because we are applying Section 12E. Section 12E capital allowances. And that has to be subtracted right over here, the value. So if you say 240,000 times 0.5 or 50%, give you the amount of 120,000 rands. That 120,000 rands, all right, it has to be subtracted from the purchase price. But at the same time, because it was, claimed in the current year of assessment, we also need to subtract that value right in the final column, right? So when you do that, it will then give you a best cost here, folks. The purchase price less capital allowance, it gives you the best cost. And the best cost, obviously, it will be 120,000 rands. And the difference between the best cost and the proceeds here, it will be the amount that we received from the insurance cover. So if I go back to the question, I would have to then read again, question 4.2. The information 4.2. So they said the fire destroyed the delivery vehicle of the company on the 1st of January 2021. The insurance company paid an amount of 100,000 excluding VAT. So the 100,000 rands that we received from the insurance cover, that's what would constitute of what? In fact, if you want to make it easier, you would have to show it this way, all right? So you need the proceeds, which is to the value of 120,000. And you would need to subtract from that the best cost. Best cost which you were given, which is how much? So the proceeds is not 120, my apologies. It's actually 100,000 because that's what we got from the insurance cover. But then the best cost, we have already calculated it. It's 120,000. So if you look at the difference between the proceeds, all right, and the best cost, what do you see? Is the proceeds lesser or is it greater than the best cost? That's my question to you.
The proceeds is less than the base cost.
Right. The proceeds is less than the what? The best cost. Now, because I know I might not have taught you this concept yet, but the moment you have a scenario where proceeds are less than the best cost, it will result in what we call scrapping allowances. Are we together, guys? It will result in what we call scrapping allowances. Scrapping allowances because the proceeds are lesser than the what? Less than the base cost. So the scrapping allowance is the difference here between the base cost and the proceeds, which is going to give you the value of 20,000 rands. Now, my question would be now, however, suppose if the base cost was lesser than the proceeds, let's assume for some reasons, okay, this is now just for illustration purposes, but remember our answer in this case is supposed to look exactly the way I just did it here. For capital gains purposes, it's supposed to be like this. So suppose I'm doing this because of illustration purposes, right? So what I would do, I'll just change colors here, right? Just what I'm gonna, you have to take it back anyways. So suppose if this was 160,000. Okay? If it was like this, instead of us having scrapping allowances, we were gonna have recoupment. Okay? And the recoupment here, it will be limited, obviously, to maximum capital allowances claimed. So if you look at the maximum capital allowances claimed, it's actually to the value of 120,000. The difference here that you get between the 160 and the 120, it will give you 40,000. So that 40,000, it's just what we call normal accounting profit. That amount you would have to then compare it against the capital allowances to determine your recoupment. So in this case, what would have happened? Because the value of 40, it will be below the capital allowances. So you would be allowed in this case to add to your taxable income calculation the recoupment value of 40,000. That's what we would have done, supposing the proceeds were bigger or greater than the best cost. However, in this case, that was not the scenario. All right? That was not the scenario. The scenario was such that the proceeds were lesser than the best cost. So obviously, it would result in what we call scrapping allowances to the value of 20,000, which is basically the difference between those two figures. So we're done with the delivery vehicles. That's all that you needed to do as far as this is concerned. All right. Notice we did not have to apportion Y because, and notice we did not have to use the binding general ruling number 7 provisions in this case, because we are dealing with a small business organization and this non-manufacturing asset is above 7,000 rand. So we could not use that information. And then again, if you were not aware, you could have probably used this and we would have obtained, you would have gotten it wrong if you had done it so in that manner, right? Now, I want to just finish everything under information 4 because of the fact that, remember, in lecture 13, I was dealing with capital allowances. So I just want to finish off with everything that affects the assets in this case. So that was the delivery vehicle. Now I want to go back to the issue of buildings. So they talked about the factory building. So let me see. And they wanted us to go through note number 4.1. So there's a factory building, which they bought for 2.6 billion rands. When was it acquired? 30th of October, 2019. Okay. So meaning to say in this case, they will qualify for the 5% in any case. Why? Because this is after the 1st of October, 1999. So because this asset was acquired anyways in 2019, so it's already after. So it means the provisions for the building allowances under factory buildings, it will apply to this particular organization. But let's see more details and find out what makes up that 2.6 billion. Now, GS made an offer to purchase a new factory building on the 1st of July, 2019. Offer was accepted. The company acquired the building on the 30th of October, 2019. GS was able to prove to SARS that 10% of the building will be used as offices. Okay? Where? In the factory building, 5% as storage space, and the remaining 85% for the manufacturing process. It's crucial to take note of what they are telling you here. Company incurred interest on the funds borrowed to acquire the factory building amount to 125,000 for the 2021 financial year. During the 2021 financial year, the company also repaid 120,000 on the capital outstanding on these borrowed funds. Anyways, it's not an issue. What is critical here, and I'm just going to show it over the footnote, but I'll also put it in the Word document. So the first thing first, because it's a factory building, but then as much as it's a factory building, we see that there is a breakdown in terms of what their building is intended to be used for. So as far as factory or building allowances in this case, in terms of the factory, building is concerned, sorry, factory building. Here's what you need to do. First thing first, you take the total value, 2.6 million, that you were given over here. And then you take cognition of the apportionment that they've given you in terms of percentages. So they are telling you 85%, the manufacturing building is used for, 85% portion of that factory building that is in place is used primarily for manufacturing processes. So you have to take the 2.6 multiplied by the 85% apportionment for factory purposes or manufacturing purposes. And then you multiply it by the 0.05, which is 5%, claim for building allowances according to section 13, subsection 1 of the Income Tax Act. When you do that, it will give you the capital allowances over the building. So that's the calculation. So what you do, you come over here, guys. Soon after the aspect about delivery vehicle, you'd write here building allowances, and this is applicable for or to the factory building. Right. So for the factory building, your calculation, of course, in this case, if you want to also indicate section numbers in case, it will be section 13, subsection 1, the Income Tax Act. So the calculation, as I was showing you earlier, it will be 2 million point 6. Is it 2 million point 6 or 2.7? Yeah, 2,600,000. And this entire thing, colleagues, is multiplied by 85%, and then you bring in the 5%, or you can just write it directly as it is, 5%. So when you do the mathematics, how much does it give you? Should get something like 110,000.
Yes, 500.
Yeah, something like that. All right. And then notice there's another aspect about this building, and I'm going to show it to you in the info. All right, that very same building. Notice the offer was accepted and the company acquired the building and was able to prove to us that 10% of the building will be used as offices and staff cafeteria, right? So there is an aspect about commercial building here, or administrative buildings, which also SARS allow anyways for the taxpayer to claim a 5% on that. Then there's another part, which is 5% as storage space, and the remaining portion, of course, is for the manufacturing purposes. So what you're gonna do, you're just simply gonna break it down like this. Okay. So here you just need to indicate that this is the portion for administrative purposes. So it will be like this, 2.6 million. And then you multiply the entire thing by 10%, 5% provisions would still apply in this case. So if you do the mathematics, how much are you going to get?
260,000.
How much?
260,000.
Yeah, it will give you 260,000. 260,000. It's giving me 18,000. Because 2.6 times 10% times 5% should give you something like 13.
Oh, I didn't add the 5, sorry.
Yeah, you should have added it. Right. So on this one, obviously, it's going to be section 13. Section 13 what? Queen. Section 13 Queen of the Income Tax Act. That will be applicable to this part of the office building, right? Now, this according to the income tax, for storage purposes, they don't give you any capital allowances claim. So we are not gonna use that 5% as storage space claim. We can't claim capital allowances over that. The only provisions that we are allowed to claim building allowances on its own administrative buildings, commercial buildings, and what else? Residential units. There's not buildings that are used for storage purposes. So that's why I'm not going to account for that aspect about storage. Why? Because in this case, we are not given any provisions of the Income Tax Act that accounts for that. So we are not going to deal with that 5% portion, right? So as far as we're concerned, we're done with the factory buildings. We're done also with the delivery vehicle. So the only one that we are left with now is the manufacturing machine. Now, with the manufacturing machine, notice there was no any note that we needed to read through. But one thing for sure, the manufacturing machine was acquired for 350,000 when on the 1st of August in 2020, 1st of August 2020 appears within the current year of assessment, which is the 2021 year of assessment in this particular entity. So it follows this machine was bought in the current year of assessment in this question. So it qualifies for the taxpayer to claim the capital allowances in terms of section 12E of the Income Tax Act. So we're going to say the manufacturing machine, in this case, so it's manufacturing machine capital allowances, and the applicable act is section 12E. Okay. So with section 12E, SARS allows you to claim on the purchase price of the asset, you are allowed to claim 100% of that particular asset's purchase price in the year of purchase. So in this case, means we are allowed to claim the entire amount on the manufacturing asset of 350,000 rands. That's all that you needed to do. And as far as this manufacturing machine is concerned, technically we are done with information number 4 aspects.